battling the relentlessly negative doom and gloom news media. It's the Nick Stenger Show, coming to you live from the Stenger Family Office headquarters. It's your host, Nick Stenger.
All right, ladies and gentlemen, welcome back to the Nick Stenger Show, episode 179. Thanks for coming back each and every week. You were thinking about taking a week off here or there, not watching the show, and then we had a big correction, markets down 8-9%, and you're right back at it, joining us each and every week again. So thanks for being here. If you haven't subscribed yet, if you haven't shared it with your friends and family, please do so. It helps us get the good news, the clarity, and the confidence out to more and more people. If you're watching on YouTube, Apple, and Spotify, share it. Subscribe to it. Get it out to more and more people. We did have a great comment that came in, I think, yesterday from YouTube, and somebody named Maestro commented, Nick, you look like you're 30. To which I responded, yes, I am 30. Thank you. You nailed it. And they said, my underwear has been around longer than you. And I was thinking to myself, that's kind of gross. I'm not sure why you're keeping your underwear for 30 years, but well, I guess that's your prerogative. So enjoy. Thanks for being on the show, whoever you are, and participating in your own special way there, commenting, I'm sure, in your mom's basement. But it's all good. So thank you for coming back. Episode 179. We are giving you the clarity and confidence like we promised we would do. And this is when we need it. And so what I want to tell you today very clearly is do not panic. Let not your heart be troubled. And we did that episode last week. Don't panic yet. And the yet was just to say you should panic if you're not doing this on a plan. If you're winging it, if you're just at the whims of your emotions, if you're looking at what Tesla does one day to the next, or you're looking at what somebody tweets out from the Oval Office, and that's what's driving your decision-making process, you're not on a plan. And so what we want to do is have you on a goals-based financial plan. We told you a correction was coming at some point, and here it is. It came a little bit sooner than I expected, but here we are. And so during these corrections, we're not surprised. We're ready for them. We're anticipating them. And so what a goals-based plan lets you do is become proactive with your investment future, with your financial future. And so that's what we want to do. I had a client who came in the other day. He's finally retiring after a long career and rolling over money and all the rest of it. And he's really worried. And he's saying, Nick, this is the first time I've ever really been worried about the market. And, I was working, earning income, just putting money in my 401k for 30 years and never even thought about market ups and downs and corrections and all the rest of it. Well, now I'm scared. I'm really nervous. And I said, don't worry. We've already got a plan for you. And so if we've got, like I've told you on the show, 3 to 5 years of living expenses set aside in short-term, high-quality, safe U.S. Treasuries paying you some interest along the way, you're not going to have to sell your stocks when times are tough. And statistically, the market is going to make a recovery, and it's not going to take that long. Even in the worst of scenarios, the average time to recover with reinvested dividends is 22 months. That includes 08 and 09. It includes 01 with the tech crisis in 1987 and 1991 and Brexit and Grexit and all the doom and gloom that you've heard about. So why should you panic? If you're on a plan, you're going to be fine. Your future is secure. If you're not on a plan, you should be worried because you're just doing whatever the media tells you to do. And I'll tell you, we feel the same fear that our clients feel at Stenger Family Office. We're sitting around with our investment committee and having our meetings and talking a little bit more regularly now when we have these corrections, looking for some buying opportunities. We may do a rebalance here at some point pretty soon. And we feel the same fear. But the difference is we've got this thing that I like to call grief sharing. We get to talk about it. We get to throw the stats and statistics and the math and the data and the money, the numbers about where the market's really headed back and forth to each other. And when we do that, we start to build up the confidence that the future is going to be bigger than the past. And so you need that too. You need to come back and hear all the good things that are going on. You need to hear the statistics. You need to hear the quotes from the most famous mutual fund managers and the most prominent investors. And you need to hear the Peter Lynch quotes that most of our money or most of the money lost in a correction is preparing for the correction, not in the actual correction itself. And how about Shelby Davis, that you make most of your money in a correction, you just don't realize it at the time. And so you got to know these things. You have to hold on to these quotes and the statistics and the information that's going on behind the scenes so that you don't make a big bad decision, which would be selling out of the market and panicking. And so it can happen to anyone. We've had people over the years where they've been good for 3, 4, 5, maybe 6 of the big sell-offs, and then all of a sudden on the 7th one, they panic. They just can't take it anymore, and they never return to the market again, and that is just tragic. You do not want to do that. So, Stenger Family Office, about 550 clients that we work with. We have not lost a single person, knock on wood here, this correction, and I got a text from somebody the other day, same person that always panics right at the bottom. In fact, I know it's the bottom because I get a text from them saying, oh, I got to get out. This is horrible. This is awful. And I just know as soon as I get that text, we got to be really close because they always want to get out at the bottom. And so you just can't do that. Just stay on your plan, ignore the day-to-day. And if you're on a goals-based financial plan, you will be okay. So what's going on underneath the surface? Well, we certainly are seeing some weakening with some segment of the consumers. But when you look at the highest 10%, and I'm not saying this is a good thing. I'm not saying we should, this is a permanent thing we should want. But it's just the reality of the economy we have today. The top 10% account for 50% of the spending in our country. And when that happens, when they're still spending money, it's good for everybody else. Think about where people are spending money. A lot of you, our clients, baby boomers, when you retire, the last thing you're going to do when you retire is sit at home. What are you going to do? You're going to go out and spend money. You're going to go travel. You're going to buy a new car. You might, take your grandkids somewhere. You might do some gifting. Who knows what you're going to do? But you're definitely not just sitting at home. And so because we've got 10,000 baby boomers a day retiring, many of which are debt-free, many of which have assets, many of which aren't going to go out and get a new house and a mortgage and all the rest of it. They're going to go out and spend money in the economy. And that eventually ends up with people who work in the services sector, people who work in manufacturing, people who work in all different industries. And so Ferrari last year sold more cars than ever before. I told you this last week. We're seeing record TSA travel numbers. The beaches in Europe were packed last summer, and I think they're going to be again this year. And so you just got to realize the underlying economy is still strong. This is not '08 and '09. In '08 and '09, we had some structural issues that were corrected. Some of them were overcorrected, but they're fixed. And so people just don't have the horrible balance sheets that they had going into the last crisis. And so while history doesn't necessarily repeat itself, some people like to say that it rhymes. Every correction that we've been through is slightly different. We had a tech bubble in 1999. We had '08, '09 was kind of a real estate bubble. We've had different crises. We've had oil crises in the past. But they're all different. They all have different reasons and circumstances surrounding them. And that's why it's so hard to time them. It's so hard to figure out, oh, this is the next tech bubble. And so you've got a lot of these doom and gloomers out there who have been saying we are going to have another tech bubble. Well, if you look at the data, yes, there are some tech companies that are radically overvalued. I'm not going to name specific names, but some of them are extremely, extremely pricey. They're 200, 300, 400 times earnings. And so the bigger PE ratio you have, the more expensive your stock. When you have a normal market correction like we're going through today, the harder you fall. And that's just the reality. So if you have a regular PE stock, like a 14, 15, 16 time multiple company, which by the way, there's plenty of them out there, a bunch of really good companies that are on sale right now, they don't fall quite as hard. They might be down 10% in a correction versus 20 or 30. And so we feel that as you move through retirement, as you get closer and closer to 60 or 70 or 80, that you'd want to have lower PE stocks in general. Not all low PE, but you'd want to have some value mixed into the portfolio. If you're 30 or 40, you could have a tilt towards growth. If you're 60, 70, you might have a little bit more value or dividend stocks bolstering you on the downside. And so the construction of the portfolio also makes a huge impact on your long-term plan so that you don't have these wild, wild swings in either direction. And so again, just like you saw in 1999 with the tech bubble, in 2021, you saw a lot of runaway tech stocks get priced up to 200, 300, 400 times earnings. You saw the meme stock craze. You saw the pot stocks, the solar stocks, and all these different coins that people came out with that turned out to be pump and dump scams, which we warned you of. And you're starting to see some of that return. Not the same level of exuberance that you saw in 21, but you're definitely starting to see some of that return to markets now, and we've kept you away from it. So if we can keep you away from these wild swings, we may not every single year put up face ripper 30% returns, but our job is to keep you in the middle of the road so you don't have these massive drawdowns when times get tough. And I think if you do that over time, you're rebalancing along the way, you're going to experience this thing called sector rotation. And so this is the lifeblood of a long-term bull market, which I think we're in today. And you just have to remember when CNBC or Fox Business, they're talking about the S&P 500, they're literally talking about 500 unique different companies. Some of them are energy companies. Some of them are utilities. Some of them are financial. Some of them are tech companies. And so if you own a variety of companies at any point in time, some are probably doing better, some are not doing as well. And there's this rotation, we call it sector rotation, that goes on in the portfolio. Right now, oil companies are actually bolstering returns. They didn't do that well last year, but they're holding their own this year, and that's holding up some of the portfolio. Financials had a couple of tough years. Financials are coming back, and healthcare stocks this year are coming back. Actually, real estate is coming back in a surprising way in 2025. And so because of that, part of your portfolio is going to be up, part is going to be down. And then we like to rebalance. We like to trim some profit and put it in some of the things that aren't doing so well, which sort of seems counterintuitive. But if you look at that chart, the periodic table chart of sector returns, what you see is that the one sector that did really well in one year, and it's at the top, might end up at the bottom the next year. And so that's why you rebalance. That's why you are consistent over time. So all that to say, you've got to be on a plan. I keep hammering this point home because you just have to do this on a plan. I want to put this current correction into perspective and just tell you why I think people are absolutely out of their minds right now with where they think markets are headed, or blaming President Trump. And by the way, I don't mean this as a political statement, but a lot of people are blaming Trump because we're in a correction. Well, that's not the case. And by the way, when Biden was president, we didn't blame him for a correction either. So some of you are saying, oh, Nick, you're just a right-wing guy or something. You lean red, so of course you're going to say that. Well, just before you leave a nasty YouTube comment, okay, just go watch a couple of the shows from last year. Go watch a couple of the shows from the year before. And just listen before you decide to leave that comment, because even when Biden was president, we didn't change our tune. We didn't like all of his policies, but we said stay in the market. We said we think economy's going to do fine, and we think things are going to be okay. So every 4 years in the first year of the presidential cycle, there's of course going to be uncertainty. Obviously, there's uncertainty. So if you're surprised by that, that's kind of your own fault. When Biden came into office, everybody was panicking. Everybody was worried. And the people that hated Biden were calling us and saying, Nick, you got to get me out, and Biden's going to take us off a ledge here. And I said, no, just stay on your plan. Everything's going to be okay. And sure enough, it was. And now with Trump, the other side of the country that hates Trump and hates what his agenda is, okay, fine. Well, they're worried now about the markets this time around. And I'm telling them the same advice. So just realize that over time, politics don't dictate returns as much as companies do. Companies, management teams produce earnings. They make decisions, even hundreds and thousands of micro decisions every day and every year that add up to big things. And if you look at companies over 2 quarters, 3 quarters, 4 quarters, it doesn't tell you that much. But when you zoom out, we like to say, when in doubt, zoom out. When you look at companies over 2, 3, 4, 5 years, if their strategy works, what happens? They rise in the S&P 500. The S&P 500 is a meritocracy. So the better and better these companies get, the better they are at producing sustainable profits, the higher they become in the portfolio. And so when you're in a top 50 portfolio of the S&P 500, for example, what happens is you have a high-quality stock portfolio just naturally, because the best companies rise higher. So let's just put this correction in context. I did this last week, but I want to do it one more time here this week. Right now, we're about 9% of the way into a correction. In December of 2024, we dropped 4% in 2 weeks. In July of 2024, we dropped 8.5% in a month and a half. Go back to March of 2024. We dropped 5.36% in March of 2024. Go back to 2021. So you can't blame President Trump for this one. And again, I'm not telling you should blame Biden. It was neither of their faults. The S&P dropped 24% in December of 2021 to October of 2022. So a lot of this is really Fed driven. A lot of it is earnings driven. And so the market is this discounting mechanism. I haven't said this in a while on the show, but I'll bring this up one more time before we wrap up today. The market is a discounting mechanism. It's a forward-looking indicator of what's to come. And the market knows what's coming. We know that Powell's got a meeting next week. He's got a speech. He did a speech yesterday, and he essentially is trying to front run the real Fed meeting next week. And he's trying to say, hey, we're probably going to stay put where we're at. Next week, I think he may change his tune a little bit. The market knows that. The market knows this meeting's coming. The market also knows that Q1 earnings are not all that far away. We're going to start getting S&P earnings for the first quarter this year very, very soon in the first few weeks of April. And when you start to see earnings come out is usually what dictates where the market goes the rest of the year. These tariffs are not going to impact Q1 earnings. A lot of them don't even go into effect until April. And again, I'm not trying to tell you this as a political thing, but I think Trump is using the tariffs like he did last time around as a negotiating tool. I don't think they're going to stick. I don't think they're going to be a long-term, all-out Smoot-Hawley style trade tariff war like we had in the Great Depression. And remember, the Great Depression had a variety of factors going on, not just tariffs. But I believe they're a negotiating tactic. There's also some sense out there that I think President Trump could be using this. I don't know this for sure. This isn't verified. But my guess is he may be using this to get the Fed to blink. He's said for a very long time now he's really focused on the 10-year Treasury. He wants to get the 10-year lower. So it's possible if you look at the UK, if you look at a lot of other countries in Europe, if you look at China, they're saying with tariffs now we're going to be forced to cut interest rates. Well, it's possible Trump is looking at that and saying, hey, if I can threaten the Fed almost with tariffs, and again, I'm not saying you should agree with this or disagree with it, but I think this is possibly what's going on. He could get the Fed to blink and cut rates. And if that happens, the market could be up 7% the next day. We've lived through that a million times in the past where the market's down 10%. And all of a sudden, if you miss that one day where it rallies, it literally, that one day takes you back to where you would have been at the 6150 all-time high level. And you could miss it. So you just can't time this. The market's a discounting mechanism. It's telling you what's coming. And so now the market's down to 56, 56.50, and we are going to trade it at 17 times forward earnings. So if you could buy the S&P at 17 times forward earnings, you'd say, is that overvalued? Is that overpriced? And I'd say just look back at history. And for the past 5, 6, 7 years, we've traded the S&P at 15, 16, about 17 times forward earnings. That's been the 5-year average. So the market is not radically overvalued here. We are not in a 1999 style bubble. We are not in a position where the world is going to come to an end. So I am going to tell you again, just like I told you this week, stay on your plan. Hold the line. And again, I've got the crystal ball right here in the studio. And, if I look into the crystal ball, I say, when's the correction going to end? And if I had to guess, I'd say maybe we go down 10.5% like we did 2 years ago in 2023. That's possibly where we end up. So be prepared for some volatility. Be prepared for a little bit more downside before we go up. But if you can just stay on your plan, if you can just hold the line and get past this nonsense and get past the doom and gloom, you're going to make it out the other side alive. Thanks for being on this episode 179. We'll see you next week for episode 180.